Welcome to our bi-weekly US Market Outlook webinar. My name is Mingjin, and I'm going to be our moderator for today. So I've actually previously shared on the technical analysis of the FANG stocks, and also I'm just going to give a brief summary of the previous webinar that we held 2 weeks ago. We have shared on the FOMC rate cut of the 25 basis point, and also how the market reacted. And in today's webinar, I would like to introduce our Phillip research analyst, Edmund, who will be sharing with you insights on the US market, and also Wei Ren, who will be sharing with you on the technical analysis of the different sectors and counters. Okay, so in the meantime, if you have any questions, do feel free to post on the Q&A tab at the bottom of your webinar screen, and we will only answer your questions at the end of the webinar.
All right, thank you, Minjin. So for the agenda for today, we're going to cover the banking sector outlook, followed by our thematic investing for cloud computing. Last but not least, we'll cover 2 internet stocks, Amazon and Facebook. So to start off for the banking sector, the banking sector is a very cyclical and follows the economic cycle closely. So I think a lot of investors will feel that as we approach the late expansionary cycle, economic cycle, and with the yield curve inversion, I think the bank's net interest margin will be under pressure. But today we are going to show you that this may not exactly be the case because there's still room for growth. So to start off, we identify 5 key drivers for banks. The first is, of course, the pause in the rate hikes. And because there is an interest rate cut in June and there's possibly another cut in September. And as we know, for the banks, they mainly lend for the long term and borrow in the short term. So with an interest rate cut, this will be positive for the banks. As for regulatory easing, the FDIC no longer require banks to pay a quarterly surcharge. So that means it will save about $1 to $2 billion for all the large cap banks. There's also the rollback for the Dodd-Frank Act, but this is mainly for the small and regional banks. But for the large cap banks like JP Morgan, Bank of America, because they have high systemic risk, there's not much regulatory easing. As for the efficiency ratio of the large cap banks has been improving through their ongoing efforts for digitalization. There's also rationalization of the bank branches. So what do you mean by rationalization? It means that they are going to use automation and technology to expand the number of bank branches in US, but at the same time, you would lead to lower cost because of their new technologies. I will cover the loans growth and the credit quality shortly. So to start off, for the deposit repricing, the 3-month certificate of deposits and the 6-month CD have more than doubled since the start of the Fed rate hike cycle. It started from a very low base, unlike the previous Fed rate cycles. And so far, what we have seen is that for the retail side, the deposits have not shown any meaningful repricing, whereas for the wholesale side, because they have higher deposit betas, so during the recent Fed rate hike, there will be a faster repricing upwards. But right now, on the contrary, because the interest rates are moving downwards, higher deposit betas for the wholesale side will also meant that there will be faster repricing downwards as well. As for the retail side, it remains fairly flat. So this is not likely a concern for the cost of borrowing for the banks. As for the loans growth, we can see that the total loans growth year on year is about 4.9%. It still remains rather strong despite the ongoing trade war and the slowdown of the economy. If you look at the consumer loans growth year on year, it is also going very strong at 5.3% year on year. As for C&I loans and real estate, they have both declined by a little bit. C&I loans is about 6.3% year on year in July, whereas for real estate, it is 3.2%. As for consumer credit, we can see that the consumer credit outstanding is still at a high percentage. Auto loans and credit cards have also rebounded. And the latest retail sales data suggests that the US consumers are once again one of the few things that stand between the global economy. The control group sales have increased by 1% month over month in July, and the 3 month annualized growth rate has also rebounded to a very high percentage of around 10%. As for mortgage, in August, we have seen a rebound in the overall mortgage applications, which was driven by refinancing activity. And while home purchase applications have fallen further, a further drop in the 10-year Treasury yield meant that the mortgage rates will likely fall further. But given that there is tight supply of housing, concerns about the economy and more cautious lending are expected to prevent a significant rise in the home purchase demand. So I think there's a number of factors that will explain why home respond to lower interest rates. So the first is that there's an ongoing problem of a lack of home sales, and also there's concerns about the economy outlook, which has hit both the home buyer sentiment and increased lender caution. As for the banks, because of the concerns about the economic outlook and the ongoing trade tensions, they have encouraged banks to tighten the mortgage lending standards, which has offset some of the impact of lower interest rates on home sales. The survey suggests that the tightening will continue. In fact, the latest senior loan officer survey had shown that a balance of 1.6% of lenders have tightened standards on the GSE eligible mortgages in the second quarter, which is the first time that has happened since 2014. But admittedly, the level of tightening is still rather mild, and it is not set to crash housing market activity. So we are likely to see real estate loans and especially mortgage loans to remain at a significant growth rate. As for credit losses, the credit quality for the bank loans continue to be very benign. If you look at the delinquent loans and charge-offs, they remain at very low levels as compared to the global financial crisis. And in terms of valuations, it currently has the lowest PE and PB ratio of all the other sectors. And it is currently trading at about 10.9, which is lower than its historical average. That's why we may remain overweight on the banking sector. And we believe that the investors' concerns about the Fed and the yield curve inversion may not necessarily have a strong impact on the banks. And we think its attractive valuation, benign asset quality, and also its strong, robust loan activity is likely to ensure further growth for the US banks. So these are a few ETFs that tracks the banking sector, and our preferred company will be JP Morgan. So next, I'll move on to our thematic investing, which is cloud computing. So a little bit of a background for cloud computing for those that may not know what this is. So basically, cloud computing is the delivery of computing services, which may include things like servers, storages, over the internet. So instead of a physical data center, all of this will be done over the internet as long as you have a fast enough fiber network. So you usually just pay for cloud services, which is pay per use, which will help you to lower your operating costs and also scale your businesses. So we track a list of so we track the capital expenditure for the list of the top 14 companies that we see with exposure to cloud computing. And currently, it was down 1% year on year, which is a sharp reversal from the 19% year on year growth in Q4 18. We see lower spending for most of the 14 companies. We also see mixed results from the component vendors, which signal a softer cloud capital expenditure for Q2, which would affirm that the cloud digestion may be fading. So on the memory side, we see that Seagate has reported shipments that is down 12%. Western Digital also noted a slowdown. As for the data centers, it's rather mixed, with Cyrus One reporting strong demand from the US hyperscales, whereas Digital Realty pointed out that the cloud remains in digestion mode for Q1, but they also see a greater demand for hyperscales. While Digital Realty pointed out that cloud remains in digestion mode for Q1, but there will be a greater demand from hyperscales for connected campus co-location services. So this is just a list of all the constructive projects to show that there's still ongoing expansion for building of cloud data centers. There's also one that's being built in Singapore as well. One of his key clients will be Facebook. So overall, we see that the spending on cloud IT infrastructure is likely to grow about 12% CAGR, and it's likely to surpass traditional spending in by 2020. As for the AWS, which is Amazon Web Services, it is one of the largest cloud computing service providers. You can see if you use it as a proxy for the cloud computing revenue, it remains rather robust, growing at a CAGR of about 40% through 2019. And in the long term, we see that the capex for remain optimistic as hyperscales continue to expand their data center build-outs, and with enterprises switching to hybrid cloud. So we are encouraged by the pickup in the orders towards the end of Q1 and positive guidance from most of the component vendors. That's why we remain overweight on the cloud computing industry. And our preferred companies are Ciena and Digital Realty Trust. These are the only two ETFs that tracks the cloud computing sector. So next, we are going to talk about Amazon. So for Amazon, we see there are three key drivers. So the first will be the expansion into new product categories such as groceries and pharmacy, which we think will be crucial in driving Amazon's retail business growth. So Amazon already captures about 52% of the total US e-commerce market share in 2018, and it has more than half of the online market share in 7 out of 17 categories, which include like things like books and toys. And we think that the venture into groceries and pharmacy is key to the re-acceleration of venture growth, revenue growth for Amazon. The total retail sales for groceries we expect is about 680 billion in 2018. And assuming that the current trend of 3% annual growth for grocery spending continues, the total addressable market is close to 700 billion or 12% of the core retail TAM in 2019. As for pharmacies, it represents a 200 billion market opportunity in 2019. The second driver for Amazon will be Amazon Web Services, which we have talked about earlier. It continues to maintain its dominance in cloud services by leveraging on scale and expanding its service offerings. And we continue to see a robust AWS revenue growth, which is 41% year on year in Q1. And in our view, cloud remains an enormous opportunity as we estimate about 80% of the workload has yet to be migrated to cloud. And AWS, being the dominant cloud service provider, has 32% market share, followed by its competitor at 16%. So we would believe that it is able to offer more competitive price points against its competitors, given its large scale of operations and economies of scale. Last but not least, Amazon currently is also trying to grow its advertising business. The revenue growth for advertising has been more than 100% from Q1 2018 to Q4 2018. So even though revenue growth has slowed to 36% year on year for Q1 2019, we think that Amazon is still well positioned due to its scale and the availability of data from in-market customers. So what I mean by that is that unlike its competitors such as Google or Microsoft, Amazon is able to collect the data of what customers have bought and what they add to their shopping carts, and they have the data for the entire journey through the completion of purchase. And with its purchase of the Whole Foods Market, WFM, it is able to make meaningful links between the online and offline shopping behaviors for its customers. And with that, you will be able to you will be able to train its algorithm such that there will be high conversion rate for its search engine. So last but not least, I will cover a little bit about Facebook. Firstly, we think that social commerce is going to be the new growth story, especially for Instagram. So Facebook announced earlier this year that they're going to add an Instagram checkout function, which will allow users to make direct purchases on the Instagram app itself. So right now, the business model for this social commerce will be that they will charge retailers a selling fee when the item is going to check out. And we think that this checkout function is mainly targeted towards SMEs, but may also attach to the attention of larger brands. So based on our estimates, e-commerce on Instagram will add about 3 billion, which is 2.9% to Facebook's ad revenue base case by 2021. A bullish case with more commercial volume and growth of the monthly active users may also yield as much as 5.3 billion revenue. The next driver for Facebook will be, of course, is popular Instagram stories and its ads for Instagram stories. So although Facebook mentioned that stories has commanded lower ad prices than the traditional news feed, we are still rather bullish on its high growth opportunity. And although the numbers may not be very transparent to us, but according to the management, the number of advertisers using stories ads have increased from 2 million in Q4 2018 to 3 million in Q1 2019. And Facebook have mentioned during the conference call that impression growth continues to be driven mainly by ads for Instagram stories. And the year-on-year decline in average price per ad reflects an ongoing shift towards the stories ads. So with that, I'll pass on my time back to Mingjun.
Okay, thank you, Wei Ren, for the presentation on the sector's outlook and also the counters. So right now, I'll have a little poll which I'll be sharing on checking on which markets would you be interested to hear from us. And so you can indicate your interest here. You can select multiple options in this poll that I've just launched. While I'll be sharing with you on the latest promotion that PhillipCapital has come up with. Okay, right now there is this promotion on transferring in your US shares to receive up to $88 worth of trade rebate. And this promotion is only valid from 6th of September till the end of the year. And of course, these are the important things that you need to take note here. Okay, so for more details, you can actually find out in our website stated in the link in the PowerPoint that they can see. Or if not, you can also contact your trading rep for more information. With that, now I'll pass on to Wei Ren, who will be sharing on the technical analysis of indices and different counters.
Okay, thank you, Mingjun. Okay, so I'll share with you guys on the Dow Jones Industrial Average. Basically, we are still for the Dow Jones daily chart. There's an expanding triangle fifth wave movement. So currently, we have completed the D wave, and right now the first wave and the second and the potential second wave is going to complete. So once the second wave is completed, we will be expecting a 3-wave down to form wave wave D, sorry. So once we are expecting a reversal at 24,000, and then should there be a reversal at 24,000, the next target we'll be looking at is beyond 28,000, and then the next target is 30,000. However, should the supply zone listed here at 27,000, 087 to 27,400 is being tested and broken, then we can see that there will be a high chance that the Dow Jones will actually hit 30,000 earlier than we expected. Then next, I'll go on to the poem chart. And for that, I will share with you one of the counter that we're looking at is Lockheed Martin. Oh, give me a moment. So we'll be showing Lockheed Martin because it's a very interesting technicals. Let's just give me a while. Okay, thank you. Yes. Okay, thank you. So for this, for Lockheed Martin, currently we are currently at the support. Okay, so sorry, there's some technical issue. Okay, so let's move on. For 4 periods ago, there's actually last week there's a bearish engulfing pattern at the top of the trend, and price did actually have a retracement back to $370 at near the psychological level, and coincidentally, it's also near to the support of 368 over here at the high, and it's also near to the 50 SMA. It actually reject the 50 SMA line. So we're currently very bullish on these stocks, and we believe that in the long run, in the short term, it's going to break 390 psychological level. And then for the banking sector, for Wells and Fargo's, let me just. Just let me load. Okay, good to go. So for Wells Fargo, sorry about it. So for Wells Fargo is currently on a downward ranging trend, and there's since the downfall on the cloud cover, I think last month, it goes all the way to retest a low of $43.38, near $43. So, but however, we think that the bullish run is a very short-lived, as currently it reject the $49 psychological level first, and secondly, here is a very sensitive supply zone. So this is a area where short sellers will come in, potential short sellers will come in and then push the price lower. So we expect the price is going to test $45 and then have a slight rebound, and then it ultimately will test beyond $43. So for now, I'm going. I'll share with you the two counters. So is there any counters that that the attendees you guys will want me to share early on? Okay, just now I believe my colleague Emma has already touched on the one of the counters is Sienna, one of the cloud computing components. So for Sienna, you can see that there's a double rejection at the $38 support psychological support line. So we believe that that price is going to hit higher. First is because there's a falling wedge pattern, falling wedge formation. Currently, there's a falling wedge formation. Sorry, let me just have a little time. Yes, that's right. Okay, there's a falling wedge. I can see that there's a falling wedge and 3 points have been touched. 1, 2, 3, and the fourth one after this, there'll be a strong breakout. However, the resistance we expect price in the long run will be targeting at $46. Sorry, Twitter. Let's take a look at Twitter. There's one of you asked about Twitter. Twitter is very interesting. It's still on the upward trend. Bearish engulfing candles. Sorry, give me bearish engulfing candle. Push price lower, but currently is actually have a very strong is actually currently at a support level over here at 43.25. Although it did not close above 43.25, but the clue is that that price actually touch a dip and reject the 42 SMA over here. So we are quite bullish on it, and we may think and price may actually break $45.85 at the top in the near short term. So far, okay, so I've done with my sharing for now. So we'll now proceed to the question and answer section. So for that, I'll pass on to Mingjun to carry on. Thank you.
Okay, so Wei Ren has actually just finished up on his presentation on the technical analysis. So right now, we will look through some of your questions and we will be answering them. So, okay, so right now we have this this question on can we explain on what are the factors you consider that Lockheed Martin is bullish apart from the support it is at now?
Okay. Okay. Thank you, Mingjun. I'll just go on to the chart first. To Lockheed Martin, I'll show you that apart from the current support, actually, there's a golden cross over here, as you can see, on 22nd April. On 22nd April. So this golden cross has actually not been invalidated. All three moving averages are respecting along the prices. And if you look at LA wave, right, the first wave or intermediate wave, and the second corrective wave is very shallow. And therefore, the third wave, if we pull out the extension, we are currently at only 100% of this, and we haven't even hit 161.8% of the third wave. So the third wave is likely to be at $410 to $420. That's in the long-term run, of course. So once this intermediate wave is completed, we will expect some correction down back to 370, and then thereafter we complete the fifth wave. I hope that answers your question. Thank you.
Okay, the next question we have here is how does digital banks affect US banking sector? Emma will be sharing on this.
Hi, yeah. So regarding this question, we know that in Singapore, MAS is trying to open applications for 5 new digital bank licenses. However, surprisingly, for the US banking side, the regulators are less inclined to have all digital bank without any physical presence in the US. So regarding whether this has an impact, for now, we don't see this as an issue for the large cap US banks.
Okay, so the next question is any recommended buy-in prices for the stocks that Edmund shared during his webinar?
All right. So for JP Morgan, if you look at the reports that we have published earlier, the entry price is 111.52. The stop loss is 108.23, and the target price is 134. As for Amazon, the entry price is 1,731.65. The stop loss is 1,690. The target price is 2,100. Last but not least, for Facebook, the entry price is 182.8. The stop loss is 180, and the target price is 207.70.
Okay, so right now we will also share on the technical analysis on Starbucks as requested.
Thank you very much, Mingjin, for the. Okay, give me your time to look. Okay, Starbucks actually is currently overall long-term trend is still bullish, but however, the you can see the high price at 99.72 on the 29th of July. It actually failed to hit pass and touch beyond the $100 psychological level, which the $100 is very significant. And subsequently, it came ranging down. There's a failed inside bar that this long leg doji is actually an inside bar that that is a classic continuation pattern, but it fails on the next period, and subsequently 2 period down, it actually attempt to guide to fill out the gap, and subsequently it actually has a range, but it fails to raise beyond. You look at the Fibonacci levels of the range, it fails to reach beyond the 23.6%. If you inverse it, it will be actually at near 78.6%. So for this failure to actually go beyond 78.6, right? Actually it caused a widespread downturn. That selling pressure actually came in. So I will prefer, if entrance is looking at to re-enter long, I'll say that $87.5, $87.50, sorry, pardon me, will be the best price, as there's a strong demand zone. And the next level, that should this demand zone fail, we're looking at $77.50 to be completed, to actually long. And last but not least, there's actually, based on the wave count, actually we are currently on the third wave of the minor wave count phase, and this is actually the corrective wave 4. So if actually this making ABC down wave, and then $85 is actually a better price to actually re-enter long. Thank you.
Okay, so right now we will just proceed on to one last counter for the TA sharing, which will be AMD.
Okay, AMD daily chart, it actually broke the high of this level at $35, near $35. Let me check. Yes, $35. Subsequently, it actually completed a few triple tops. However, we feel that price definitely have a chance to go higher, but we feel that the retracement level 29 to re-enter at long will be $29, will be a better price. Thank you.
Okay, so now we have come to the end of the webinar, and we hope you guys take back some information from here. And in 2 weeks' time, we will be having another webinar. We hope to see you then. Thank you.